Welcome to RBC's Markets in Motion podcast, recorded July 12, 2023. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, an update on our outlook for sectors within the U.S., and some thoughts on sectors from a global perspective based on our quant work, as well as the results of our latest RBC analyst survey, which now includes our teams from Europe, Canada, and Australia in addition to the U.S. 5 big things you need to know. First, across the globe, RBC analysts are most constructive on healthcare and least constructive on staples. Second, RBC analysts are most constructive on Europe in terms of their performance outlooks, but there is some nuance to their regional views. Third, looking at the U.S. specifically, our analysts are most constructive on the performance outlook for healthcare, energy, and financials, and least constructive on the performance outlook for discretionary staples and utilities. Fourth, in terms of our own U.S. equity strategy sector recommendations, we've made 2 changes. We've lifted financials to overweight from market weight, and we've lowered utilities from overweight to market weight. Fifth, cyclicals stand out in our work in terms of the survey and the quant work on Europe specifically. If you'd like to hear more, here's another 6 minutes. While you're waiting, a quick reminder that you can subscribe to an audio-only version of this podcast on Apple and Spotify. Now the details. Let's start with takeaway number 1. Across the globe, RBC equity analysts are most constructive on healthcare and least constructive on staples at the sector level. Questions in our survey focused on views on performance, valuation, demand, margins, artificial intelligence, company liquidity post the banking crisis, whether our analysts are seeing evidence of recession pressures in their industries, and how views on the macro have changed for them. The analysts gave us numerical responses in a range of plus to minus 2 from most to least constructive on these. Taking all regions into account, our analysts were most constructive on the performance outlook for healthcare and least constructive on the performance outlook for staples. Those biases were also in place when we looked across our team's views on all of the questions we asked. Moving on to takeaway number 2. At the regional level, RBC analysts are most constructive on Europe in terms of their performance outlooks, but there is some important nuance to their regional views. While the performance outlook was strongest for Europe, it's worth noting that the performance outlook did tilt positive for all regions except for APAC Australia, where it was basically neutral. Valuations are seen as most attractive in Canada and least attractive in APAC Australia. Margin pressures are seen as most acute in APAC Australia. The U.S. is seen as benefiting most from artificial intelligence, with analysts in most sectors anticipating a positive longer-term impact from it, not just those in the tech-related areas. Overall, the general message from our survey was that our analysts have a modestly constructive view of things. Tilts were modestly constructive on all of the questions we asked except for margins and recent shifts in the macro view, both of which tilted slightly negative. Optimism in the U.S. was strongest on our questions about AI and evidence of recession, where our analysts were basically telling us they didn't see much evidence of one. Moving on to takeaway number 3. Looking at the U.S. specifically, our analysts are most constructive on the performance outlooks for healthcare, energy, and financials, and least constructive on the performance outlooks for discretionary staples and utilities. Across all sectors, our U.S. analysts veered towards neutral on many questions, aside from those on the longer-term impact of AI and the impact of the recent banking crisis on company funding or liquidity, where they tilted a bit more constructive. Only a few sectors stood out with a negative tilt on our recession pressure question. Most of our analysts said they aren't seeing evidence of one, even though many also indicated that their concerns about the macro backdrop have grown a bit in recent months. Moving on to takeaway number 4. In terms of our own U.S. equity strategy sector recommendations, we've made 2 changes, lifting financials to overweight from market weight and lowering utilities from overweight to market weight. On utilities, our downgrade is driven by our U.S. analyst team's pessimistic performance outlook, which was new this quarter, and our own quant work indicating that valuations are expensive. The sector tends to perform a counter-cyclical role in portfolios, underperforming when ISM manufacturing rises, and we worry that any improvement in expectations around a 2024 economic recovery in the U.S. will be a headwind for the sector in terms of performance. We see healthcare as more interesting in a short-term market pullback if we get one. On financials, our upgrade is driven by our analyst team's optimistic performance outlook and our own work indicating that valuations are attractive, dividend yields are compelling, and earnings and sales revisions, though still slightly negative, have improved a bit. 2Q flows were also positive. The sector tends to serve a cyclical function in portfolios as it tends to lag when ISM manufacturing is falling and outperform when it's rising, and we suspect that if confidence in a 2024 economic recovery gathers steam, financials stands to benefit. Wrapping up with takeaway number 5, cyclicals also stand out in our survey and quant work in Europe. We aren't making any formal recommendations on regions outside of the U.S., but we are flagging some of the more interesting sectors in other regions from our surveying and quant work. Within Europe, one of these interesting sectors is also financials. Our research team is constructive in their performance outlook for the sector, and this is in alignment with our data on revisions, where financials is actually counted among one of the stronger sectors, as well as valuations, where financials look attractive. Our European team's constructive stance is contrarian from a local flows perspective, but does sync up well with the views of our U.S. analysts. Another sector that jumps out to us in our European work is industrials. On our quant data, EPS and sales revisions for the sector have been strong, but money flow impacts have been mixed, and valuations are extremely high, making their modestly positive performance outlook somewhat contrarian. Our European team stands in contrast to our U.S. team, which is more cautious on performance. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.